Welcome back to MB Capital Strategies. Today we continue our mining series, this time with SunCoke Energy. No lithium hype, no copper supercycle narrative, and no story stocks. Instead, a classic cyclical cash flow player directly embedded in the steel value chain. SunCoke produces metallurgical coke, an indispensable input for traditional steel mills. The central question today: are a 6% dividend yield, an improved balance sheet, and stable contracts enough to compensate for the steel risk? We're looking at all of this without any marketing spin. Numbers, cash flow, dividend, market risks. What exactly does SunCoke do? SunCoke is not a coal miner but a coke-making specialist. The difference is crucial. SunCoke operates modern heat recovery coke ovens. These produce metallurgical coke plus electricity as a byproduct, resulting in higher efficiency at lower costs. The business segments are divided. First, domestic coke, which accounts for 85 to 90% of revenue. Long-term take-or-pay contracts with major US steel companies such as US Steel, Steel Dynamics, and ArcelorMittal. This means that customers pay for the capacity even if they take less. Volatility is significantly lower than with spot miners. Logistics, terminals, and transportation for coal and coke. Cyclical but supportive. Industrial service through the Phoenix Global acquisition. Material handling and services for industry and mines. Diversification beyond steel. The locations are in the USA, Illinois, Indiana, Ohio, Virginia, and also Brazil. Conclusion: 70 to 80% of the volumes are contractually secured. Less price fluctuation, but the steel cycle remains the key driver. Let's take a look here at how I am invested. A total of 53 shares. My entry price was €6.46. Currently, there is an unrealized gain of €20.55. That corresponds to a price increase of 6%. A dividend that I have already received amounts to €3.72. The 52-week high and low are between €5 and €9 and currently at €6.81. Analysts have set a target of €8.53 here, and Investing Pro has set a target of €7.93. If you also want to take a look at fundamental analyses, you are welcome to use Investing Pro for that. You can find the affiliate link below in the video description. Through my link, you will receive a 15% discount. Revenue stands at $1.84 billion. We have an adjusted EBITDA between $220 and $225 million. We have a net income of $48 to $58 million and earnings per share currently at around $76. Operating cash flow is between $110 and $120 million. Capex is stable at $65 to $70 million per year. In strong years, we have a free cash flow between $90 and over $100 million. In 2025, more realistically, it will be between $40 and $60 million. This is not a free cash flow monster, but it is consistently positive. The balance sheet: we have cash of $80 million. We have total debt of $700 to $710 million. We have net debt of $620 to $630 million and a net debt to EBITDA ratio between 2.8 and 3. That is solid for a cyclical company. It used to be over 4. Debt reduction was clearly the priority here. This now provides room for dividends and, if necessary, buybacks. Phoenix Global is strategically important. A new industrial service segment, less directly dependent on steel. Synergies are expected starting in 2026. In 2025, integration costs will still weigh on the numbers in the short term. In the long term, clearly positive for stability. SunCoke is not a classic dividend aristocrat, but is above average attractive in the industrial sector. We have a quarterly dividend of $0.12. We have a dividend of around 6%. We have a dividend yield of 6%. What has the history been like here? In 2021, we were at $0.06 per quarter. Today, it's $0.12 per quarter. So we've increased it 4 years in a row. How sustainable is this? We have a payout ratio of 63% and a free cash flow payout of only between 19 and 25%. What does that mean? The dividend is not overstretched. There is room for a better cycle, no material commitment, but management clearly prioritizes the dividend alongside debt reduction. This makes SunCoke more stable and predictable than other coal miners. Metallurgical coke is needed for blast furnace steel. Globally, world steel production is 1.75 billion tons. 2025 is expected to be flat. 2026 is projected to see 1.3% growth. The USA production is 80 million tons per year. For 2026, an increase of 1.8% is expected here. What are the drivers here? Infrastructure and also replacement investments. What are the breaks? Automotive and energy capex. What speaks in favor of SunCoke? SunCoke has long-term take-or-pay contracts. US tariffs protect domestic production. No boom, but also no collapse. How is the valuation here? We have an EV/EBITDA between 4 and 6. We have a price target of $10. That corresponds to an upside between 25 and 28%. It's not a bargain like in 2020, but it's fairly valued for a 6% dividend, for positive free cash flow, and for an improved balance sheet. It's a classic cyclical buy during weakness, not during a boom. What are the risks? A steel downturn means EBITDA can fall by 30 to 50%. High customer concentration, no structural growth, debt is still present, and there is long-term EAF shift and ESG pressure. This is not a buy and forget investment. My conclusion: SunCoke is not a quality compounder, not a defensive dividend anchor, and not suitable for passive investors. But there is honest cyclical cash flow, a 6% dividend yield with a track record, take or pay contracts cushion the downside, the balance sheet has significantly improved, Phoenix Global brings diversification, and it's attractive as about 5 to 10% as an addition. My personal assessment, as you can see, is that it's more of a smaller position, since I also hold other cool mining stocks that ultimately pay out a bit more in dividends. My personal assessment is that it's just a small position. The dividend is attractive for the price, and as long as the steel market doesn't collapse, I will keep the stock for now. My personal assessment is, as an addition, that is, as a small cap, the stock has a place in my portfolio. Of course, this is not investment advice, but simply my personal strategy. That's it for this video. If you enjoyed the video, feel free to leave a like and a comment. That also helps the algorithm to show my videos to more people. If you have any questions, let me know in the comments. If you're not a subscriber yet, I'd be happy if you subscribed now. See you in the next video. I wish you successful investing.